Here we have an Apple stock. Here we have a Google stock. Here we have a 510 put that expired Friday, 10/7. 490 call that also expired Friday. All of these are 10/7 contracts here. And here's the Apple 360 call down here. Okay, relative here. That's a 360 call. What we're going to do is show once again how the public can lose all their money in options on that expiration weekly Friday contract, and how markets were making their breakouts with the equities and their reversal with the equities. And then here's what I'm going to point out. We'll start with Apple. Apple closes at 369.80, down 7.57. Okay, because that's where it was. The previous day's close was 377.37. Intraday low was 368.49 pennies. Intraday high, 377.74 pennies. Now, when this stock was up here at 377 on the intraday high, the high side right here of this 10/7 370 call was $8.10. And they have a way of making money, because if I could short 8.10 down to 2 cents, I make a lot of money. And you can see the volume of the public transaction at 30,759 intraday 370 call options. You can see what happened to the public value of that 370 call. I will also show you MMTs that the public does not sell up here at the highs. MMTs, as we have the call and put structure, and I was telling the current MMTs in the group that during this whole time we were below here, building out these shorts in the 1022 strike prices. This one that I'm going to show you here is 10/7 2011 370 strike, and it was a call, all right. Okay, and I'm going to show you, and you know it's 30,000 contracts. Okay, now we had lots of different scenarios, MMTs and MMTs. We will continue to go to the other side of these now, the very same relative strike prices, to see what the mathematical equation is between the call and the put and the current trend. Here's what I'm going to say. On Friday, right here, MMTs, this was a Friday expiration. As we all know, that the call contract was $8.10 on the high, and they took them down to 2 pennies. The prior day MMTs, this was a Thursday, on 10/6. The high was $15.65 MMTs on the high side of that retail public price, and they came down to $5 here, but they ended up closing at $8.20 here. The calendar weekly expiration 10/7 370 call goes from a high of 8.10 down here. What happens is that they were inflated value, and they had to come down to 2 cents to the very end of the Friday expiration of hitting 2 cents on the low. And that the public will ride these kinds of call options down here, and they do that every day. But at the same time that this value was going down, was losing value, the 380 put 1070 hits $3.80 on the low, and straight up it goes. And that was that 380 put that we did. The 385 put 10/7 right here hit 790 on the lows. And as the Apple reversal in the individual equity was occurring. These went, so when Apple was going down in value, look at the big breakout on this side of the market. And this is understanding the put side. When you look at the actual call side, again, you're looking at an Apple 360 call right here, lost 7.65. They close at 1720. But if I take the same Apple call and I put it over here, MMTs, which I can do, that was a 360 call. I'm going to show you the call here of what they did with the, this is a 1022 360 call. Okay, and I'm going to use this as an inflated reference back down here. And once again, it wasn't the Friday expiration. It is a calendar, third calendar of every Friday monthly expiration here. And what I'm clearly going to point out here is that the high of the contract up here was $64.74. That was super inflated. And as that was being super inflated, that meant one key element, and I'll show you exactly. MMTs, what you have right here now is a 360 put, and it's a 1022 expiration. And let me show you that when your 360 call had peaked up here in the inflated area, the put side of the market was at a low of $1.73 per contract down here now. So these are the kind of opportunities that making a market will give you. And what I'm going to show you here is just exactly what I mean. You can see that at one time the 360 put was totally inflated way up here. And it was. And the put side fell way down in value here until we hit this bottom. And we did. And we hit that bottom on 726 at 670 on the low. That was wholesale. That meant that the put was no longer inflated. And at the same time that that was happening, you can clearly see over here when that top was put in right here. Look at that. Look at the wholesale value here. And that's the call side. And it was breaking out because it was. But then we got inflated here again. And again, we had to come all the way back down to this point to more of a deflated area. I mean, once again, this price here was 51.55, and this price over here was what? The lows. And you shot up here. And you shot up here at times. So when you were reversing over here, this side of the market was breaking out, and it was wholesale here, and that was the put. And what it means is this very clearly, MMTs on 920. We put a top on a 60-minute chart, and that's what this is. And I would likely tell you as you were actually in the trades, right, Mr. Mantalk? We were doing these trades with the new MMT that also has it on live video, as it was, you know, his experience through it. When we peaked up here at 420, the major part of that was going to be 420 down to the 400 handle, but there was a pit stop about halfway in the middle here where the breakout was in this 60-minute bar to this high, and let me highlight it for you. That's going to be this piece of it right here. When we were up here, you can clearly see here that 410 was half of that 420, but then guess what happened? There was a gap down the next day and a move right back up to what was support over here, where that 60-minute breakout happened to this high right here. This gap down held where we broke out here at the beginning stage on 919, 60-minute daily bar here. You can clearly see, though, that was that clear support level, and you bounced back right smack at what was support for the breakout, meaning that this is where the last part of the breakout hit the high reversals up here from here to there, is that became your wall of resistance, and you came right back down here and you made another lower low on 922. Okay? And that was where the reversals were happening in here. The other thing about the trade was that we clearly stated, right, Mr. Mantalk? We clearly stated if you break that neckline at 400, it required a put. Okay? And as we started to go through the cycle here, correct, Chuck? This is where it went down, and then the put side in Apple was working extremely well, was it not, sir? Okay, we know that. And how do we know that? Because we know by looking at the 360 put, when this thing was torpedoing down at times over in here, when we were going straight down on this 60 minute on 929, 930, 10.3, we were having breakouts in the 360 put, were we not? Okay. Then what happened is on a 60-minute level, when we finally hit a bottom on a 60-minute chart, we had a great up move here, and all the puts went down over here, didn't they? Didn't they? They got deflated. But, I mean, and the calls and the puts, they got deflated, and that's that put. But look what happened is, look at where this last breakout was during the options expiration week on this daily chart. You can clearly see the trend cycle of the calls. That 360 put, that you'll know the 360 calls over in the other chart. That 360 put, though, I can tell you for 1022 did extremely well because the low still had a range of 780 to 1110. All right. And that you can clearly see here on the put when they get inflated up here at 21, and they're clearly coming back down to this area of 646. That meant that the put was putting in a short-term deflated value, and we've come right back up in that put with the 10-7 Friday expiration, that this put did come from 780 back up to 1110. And it's quite different. It's quite different than the weekly when you're on the actual Friday expiration day, is it not? Right. So when we go back over here and we take a look at the 360 call, we can see how the value of that 360 call lost all its value in this October contract. I mean, they were totally inflated up here at 64.74. And the date, by the way, was 9/20. And if we want to go back over here, let's go back over here to 9/20 just to see what was happening. So 9/20 was right here. Let's blow the 9/20 up and let's see what was starting to happen. On 9/20, we were putting in the all-time highs. And when we reversed on the 9/20, let me re-highlight it again for you, sir. When we were reversing over here, making the top on 9/20, we clearly started the reversal, and that started the reversal of this 360 call that was inflated. You can see the dates. That's the dates. And these are the ones. So as the 60-minute reversal had come into play and we went straight down, we finally hit and inflated back more to a deflated area, but they're not deflated. You'd have to be over here when they're deflated. And when the call was working well, back on 9/12, right here, here's 9/12 is your date. You broke to the highs to 9/20, and you broke to the highs of the call here again, but then you broke down through all of these processes, through all of these 60-minute bars. Look at the value that you had with uptrends. So if I go over here, let's just show it. This is where the breakout was. This is on 623, back at that time when Apple was shooting higher. The 360 call then was trading really good, I can tell you, back in that time frame in the summertime. But really over here is where the 360 call had its really good breakouts, was on 912. And it started over here on 9.6. And once again, if I go back over here to 9.8, but on the 12th, I can see where my calls were really burning on 9/12 2011. And they peaked. And at the time, my calls were breaking out to all-time highs up here. So when we were up here on 920, you can see where the 920 reversal happened, and Apple that got all the way down here on a 60-minute chart on Friday, right here on the options, on 10-4, we rallied up, and then we had a reversal all the way back here. Okay, this was where that breakout was, but it failed, and because of it, the 360 call closed all the way down here in all-time lows and still remains at a low level that could go a lot more if we continue downward in the trend. These can come all the way back down here and maybe lower. So that's understanding that 360 call versus this 360 put when it made lows over here on 9/21. It was a day after the actual equity, or that time frame is that equity started its move. Look at here. The low, $1.73 on the 360 put during that trend cycle, to an all-time high over here of $21.60 on 10/4. That was October 4th. And then they lost all their value. And you can clearly see on this 60-minute chart, you can see what was happening on 10/4. I went straight down in the equity finally as I was making that bottom there on 10/4. You can see exactly the put was peaking at the high right here. The next 60-minute bar up is when we had the reversal from 21.60 down to 6.46. So this put lost that much premium that quickly when things were moving over here on 10/4 and I was breaking out on a 60-minute level. That's that reversal right here. That's your reversal on the 360 put. It came down and you broke out and you sell at the highs here, and then you go over and you buy the call when that breakout is happening, and selling into the peaks when you're going to reverse is how you're going to square your put to call ratio market maker trades. Here's a call and here's the puts. And how does one apply the market maker trade management versus inflated, and this is a deflated market? And most importantly though, is I have to also know in your equity platform is you've got to understand where this thing is on a 60-minute level, daily 60-minute level every day. You need to know how this is trading on a 60-minute level relative to entry and exit. So I'm deflated here. When I got that deflated on the call, I was burning off the bottom of support level in Apple, period. And my calls go straight up. And so do my trends. My trends go straight up with it. See, these are uptrends. These are call side. Call side. Equity breaking out to the highs. Put side comes into play. And that's what weighting both sides of the market, 360 call, 360 put. I got deflated and inflated within the transaction cycles of the equity price. Do you agree with this, Mr. Mantalk? And does this work? Right. Okay. And so by understanding how an options expiration really does work, because when you get over here in this documentary, look at what happened. The put side, Friday's expiration, 380 on the low, 1135 on the high. On a Friday and every single Friday on a weekly level, the 385 put, 790 on the intraday low to 16.55. This side of the market paid big money. The premium side, once again, right here to recap it, is both the 360 call lost tremendous value here. The 370 call lost tremendous value here. Went down to 1 penny. And in the video, you can see that on Thursday, these same contracts for $15.65. That went down to 2 pennies. It happens to the public in expiration. This is understanding why you're making so much money as this failure is occurring, is why you're making this money on this side of the market. Is that true, Mr. Mantalk? Well, thank you. This is a very special weekly documentary on call and put value relative to equity trends for MMTs. As a market maker in an option market, both call and put side, I'm a buyer of one and a seller of another, is how do I make profits on imbalances when a call is at the very highest value of the inflated value and the equity reverses, you're buying the other side of the market, which is these put options that go up and burn, and you automatically make the transaction because you can learn to be at times buying the calls off the bottoms, but you're constantly working with this side of the market. So when the calls and the chart starts to reverse on a 60-minute level, then you know your biggest weighting is going to be here. And what happens to the public is they get taken to the cleaners on the call side of this expiration on Apple, and same thing on Google. The 510 put went worthless. And we'll talk about Google in a different video, but look at what side of the market pays.